All right. So like I said, I'm going to cover just kind of an overview of Reg O, and then we're going to talk about some common pitfalls. So really, Regulation O governs two major areas. First of all, the extension of credit to insiders, and there's also a record keeping and disclosure component to it as well. Regulation O is really a safety and soundness regulation. Sometimes people will confuse and think that maybe it has to do with fairness. It's not a fair lending law. This is definitely a safety and soundness regulation. In a nutshell, it basically requires banks to be prudent in their lending practices to insiders in order to prevent placing the bank or the banking system at risk. All right. All right, so Reg O has to do, again, it has to do with extensions of credit to insiders. And so, who are the insiders? Well, these are directors, executive officers, principal shareholders, related interests, and insiders of the bank's affiliates. And those are all defined within the regulation, all of those terms. And so it's kind of a good time to talk about definitions real quick. Definitions are really specific to each regulation. In fact, one regulation may actually define a word or a phrase differently than another regulation. So it's good to look at the definition section of any regulation to make sure that you're understanding what all of the words in that regulation mean. Because like I said, it can vary from one regulation to another, and the same term have a different definition from one to the next. So the definition, in the definition section of Regulation O, it says that a director, and I'm not going to read all this word for word, but it says that a director, it says it's the director of the bank, whether or not receiving compensation. And then it goes on to say that an advisory director is not considered a director if the advisory director is not elected by the shareholders, is not authorized to vote, and provides solely general policy advice to the board. And then it goes on to talk about directors of affiliates as well, but we're not going to go into the depth there on that one. The next one that we'll look at here is the definition of executive officer. And as you can see, there's a lot of words on this page here. So as you can see, it can get fairly complex. So again, I'm not going to read all this to you, but it basically says that an executive officer is a person who participates or has authority to participate in major policymaking functions of the bank, whether or not the officer has an official title. The title designates the officer an assistant, or the officer is serving without salary or other compensation. So then it also, after that, it goes on to actually name the titles of all of what I call the default executive officers. So if you don't, as a bank or as a board, if you don't create a resolution that names the different, that names your executive officers who are responsible for major policymaking functions, the default would be this list up here. It says the chairman of the board, the president, every vice president, and there's a lot of vice presidents at most banks, the cashier, the secretary, and the treasurer. So it's very important, and it's actually fairly common finding that we have that a bank, perhaps will not have that resolution in place naming executive officers. So very important to have that. All right. Okay, in the next slide here, principal shareholder just means a person that directly or indirectly or acting through or in concert with one or more persons owns, controls, or has the power to vote more than 10% of any class of voting securities. Shares owned or controlled by a member of an individual's immediate family are considered to be held by the individual. And, as you can see these words, some of these words are lit up blue. Any of these words that have that are lit up blue like this, you can click on them if you're actually in the regulation. You can click on it and it'll take you to the definition of that word. So all these words, even the word person, you may think you know what a person is, but you click on it and it tells you something different. But so immediate family members. So if you have, you basically can't, have your wife or husband or children own stock and get out of this, principal shareholder category. All right, and a related interest is, it is a related interest of a person means a company that is controlled by that person, or a political or campaign committee that's controlled by that person, or the funds or services of which will benefit that person. And so just a few more definitions here that are important. Insider means executive, like we said before, executive officer, director, or principal shareholder, and includes any related interests of that person. And affiliate means any company of which a member bank is a sub, or any other sub of that company. All right, and polling question. All right, so does your bank currently have a formal board resolution to designate executive officers? Now, I don't know that do we have these actual questions that are gonna, okay, we do. There you go. All right. All right, I think we've got, all right, so 50% so far, 50% say yes, 41% not sure. Okay, it's going up a little bit, 56% say yes. So, but there are some that say no, 8% says no. So definitely want to make sure that you have a formal board resolution. It can be in the bylaws as well, but we typically see it in the resolution designating who the executive officers are. All right, so keep going here. Okay, so now let's talk about an extension of credit. So what is an extension of credit? It's not just a loan, okay? There's an entire section of the regulation that's devoted to this, which we've summarized on this slide. So it includes the making or renewal of any loan, the granting of a line of credit, whether it's funded or not. So you can have a home equity line or a commercial line of credit, for example, sitting there unfunded. It's still considered an extension of credit. And would still need to be reported on, for call report purposes, even though it may be at a zero balance. The limit on it would still need to be part of that calculation. Repurchase agreements, advance by means of an overdraft. So if you overdraw checking account, that could be considered, or it would be considered an extension of credit. Standby letters of credit. I think that's one that could easily be missed in the record keeping. Indebtedness upon which insider is liable as a maker, drawer, endorser, guarantor, or surety. So if you're signing for someone else on someone else's loan, you could be pulled into that loan could be pulled into this definition of extension of credit. Increases of existing indebtedness, salary advances over 30 days, and then there's sort of a catch-all at the end. It's any other similar transaction in which a person becomes obligated to pay money to the bank. So that's a pretty broad category there. There are some exceptions, and there's actually lots of exceptions built into Regulation O. So it's important to read the full regulation if you're trying to get a good understanding of it and see, not only what it says, but also what it says that the exceptions are. So a couple of exceptions to the definition of extension of credit are overdraft protection of $5,000 or less, and a credit card of $15,000 or less. And those, again, we were talking about the call report, those are not considered extensions of credit if they're below those thresholds. And so you would actually not want to include those in the call report for that calculation on Schedule RCM. And that's fairly common finding that we have, is that those numbers do typically get included in there. And there's several other exceptions, too many to list on this slide here. All right. And then there's a concept called tangible economic benefit rule. And this says that an extension of credit is considered made to an insider to the extent that the proceeds are transferred to the insider or are used for the tangible economic benefit of the insider. So I love how they use the term in the definition. I think I learned in elementary school that you can't do that, but I guess the government doesn't have to abide by those elementary school rules. But basically, if the insider receives the benefit, even if the extension of credit is not in their name, it can be considered an extension of credit to them if they're receiving the proceeds or the benefit, economic benefit from it. All right, so the next part is terms and credit worthiness. This sort of gets into the meat of the regulation. So it says, and I'm going to, pardon me for reading this first little section to you, but it says no member bank may extend credit to any insider of the bank or insider of its affiliates unless the extension of credit is made on substantially the same terms, including interest rates and collateral, as and following credit underwriting procedures that are not less stringent than those prevailing at the time for comparable transactions by the bank with other persons that are not covered by this part and are not employed by the bank. So basically, same terms and same underwriting standards need to apply for insiders that would apply for a non-insider. And that's really the most, I would say, the most important. Well, I hate to rate it and say they're the most important, but it's one of the most important parts of this entire regulation. And it's basically the term used is for that is preferential treatment. So you don't want to give preferential treatment to an insider, when you're doing a loan, basically, or an extension of credit. The interest rate needs to be the same as it would be for a non-insider. The terms, if you'll only do 10 years on a loan and you do 15 for an insider, that's preferential treatment. Collateral, if you're going to accept, if you'll accept only certain collateral for a type of loan for a non-insider, you need to keep those same standards for a non-insider. And the underwriting standards, everything about the underwriting standards in terms of the documentation you require. You can't just take an insider's word for something when you wouldn't take the word from a non-insider, that type of thing. So you need to be careful with those types of things too, and make sure that you have good documentation in the files to show that, you basically, have the same terms in place that you would for a non-insider and the same underwriting standards. Now notice there, excuse me, notice that there is an exception listed at the bottom here, number 2. And the exception is it's a benefit or compensation program that is widely available to employees. That would be something like an employee loan program, for example. As long as the insider is not given preference over other employees, then that is an acceptable thing to do. The insider can participate in the employee loan program or benefit or compensation program. So just an example on that, like I said, I used to work for Bank of America years ago. They had a really strong employee loan program. If I remember correctly, they even, I think they gave me a down payment even of like $2,500. This was like several years ago, so this was pretty good. They offered a little bit lower interest rate, maybe 0.25%. They waived the loan fee. And this was something that they did for all the employees. I think it was all full-time employees, if I remember correctly. But so that type of program, because it was widely available to employees, an insider would have been able to participate in that. But now, if they said instead of $2,500, if they said, "Oh, we'll give insiders $5,000 as a down payment assistance," that would have been preference or preferential treatment. So that would not have qualified for the exceptions. All right. Okay, so that brings us to the prior approval slide here. So again, not going to read all this. These are just kind of clips, snippets from the regulation. But basically this says that if an insider has aggregated extensions of credit, the balances, like the total balances, that exceed a certain calculated threshold. And that threshold, it's normally 500,000. It can be more, but typically for the banks that we audit, it ends up falling at the 500,000 mark. But if those aggregated balances for that insider, including their related interests, exceed that number, then they have to, any new extension of credit would have to have prior board approval prior to the consummation of the loan. And in addition to that, so in addition to that, the interested party, director, executive officer, whoever it is, they have to abstain from the vote. And a very important part here, they also cannot participate in the discussion. A lot of times we'll see documented in the board minutes that, so-and-so abstained from the vote. It's important, I think it's important to also put in there in the board minutes that they left the room prior to the discussion, and they abstained from the vote. Because if they participate in the discussion, but then not the vote, they still are involved indirectly. So that little section up there, number Roman numeral 2 up there, it says the interested party has abstained from participating directly or indirectly in the voting. So if they're part of the discussion, then that falls under that indirectly category. Another little nuance to this is number 3 on the slide. And again, not going to read that word for word, but it says basically that, and this is one that's often missed. It says basically if the insider is at that 500,000 mark, if they're at that threshold where they require prior approval, and they have a line of credit, that they would need prior board approval to do a draw on that line of credit, unless the credit line was approved within the past 14 months. So for that reason, we would recommend that any line of credit to an insider would need to be set up to renew annually, and that way you're within that 14-month mark. Otherwise, you could, there could just be a simple draw on a line of credit that would if it didn't have prior board approval and you were over that 500,000 threshold, then you could be in violation. So very important there, and we do see that sometimes where they do not have the lines of credit set up to renew annually. So, and when it renews, just as a side note, when you renew it, when you do the renewal on the line of credit, you've got to make sure you, again, do the same underwriting standards that you would for a non-insider. So it can't just be like an automatic, okay, we're going to renew this. It needs to be like the same underwriting standards you would require from a non-insider as well. So, all right. So again, all these rules about preferential treatment and prior approval, et cetera, all of this is about safety and soundness, not putting the bank in jeopardy, and that sort of thing. So let's talk a little bit about lending limits, which also helps with safety and soundness. You obviously wouldn't want to lend too much money to the insiders, to an individual insider, or to the group of insiders from a safety and soundness perspective. So for individual lending limits, an individual insider's aggregate extensions of credit cannot exceed 15% of unimpaired capital and surplus. Additional 10% is allowed for loans secured by readily marketable securities, and loans to related interest must also be included in this number. And then aggregate lending limits. This is for all insiders totaled up together. Can be 100% of unimpaired surplus and capital. Banks with less than 100 million in assets can do 100% or 200% with board approval and a resolution stating that the limit is prudent, safe, and sound, and why they believe this is the case. It must also meet all capital requirements and have satisfactory composite rating on the most recent exam. And again, like I said before, there's exceptions to about everything, and this is no exception to the fact that there are exceptions. There's some exceptions on this one as well. Loans that do not get included in the aggregation, such as loans secured by government bonds, etc. And you have to see the regulation to see some of the other exceptions. All right, let's touch for a minute here on overdraft rules. All right, so this is talking about overdrafts for executive officers and directors. There's sometimes confusion about this overdraft rules section. There's some specific rules on overdrafts for executive officers and directors. It's not applicable to principal shareholders. It's not applicable to related interests. So if the executive officer has a related interest business that they're controlling person in, that business, this rule is not applicable to that. All right, so this section, it says no member bank may pay an overdraft of an executive officer or director of the bank or executive officer or director of its affiliates on an account of the bank unless the payment of funds is made in accordance with, and you have to jump down to Roman numeral 1 down there, a written pre-authorized interest-bearing extension of credit plan that specifies the method of repayment, and that's what we would refer to as overdraft protection, or a written pre-authorized transfer of funds from another account. All right, so the exception to this is what they call an inadvertent overdraft, which is basically if the executive officer or director overdraws $1,000 or less for no more than 5 business days and charges the same, and they're charged the same fees as a non-insider. All right. Okay, so next polling question. So what volume of insider loans does your bank perform? You rarely originate an insider loan, about average, or you push the envelope of the aggregate lending limit. Excuse me. All right, it looks like so far it's about average, 88% about average, 12% say rarely originates an insider loan. So, all right. I don't see any that have pushed the envelope of the aggregate lending limit, so that's probably a good thing. All right. Okay, so the executive officers have some special or additional, I guess I would say, additional restrictions, and they're fairly restrictive. They have an individual lending limit. It is the lesser of 100,000 or 2.5% of unimpaired capital on surplus. Excuse me. And what we see is with most of our banks, it calculates out to 100,000. So there's exceptions, of course. So basically, an executive officer can't borrow more than $100,000 or 2.5% of unimpaired capital, the lesser of those numbers, unless it is to finance the education of the executive officer's children, to finance or refinance the purchase, construction, maintenance, or improvement of a residence of the executive officer. Now, only first lien counts, and the property has to be owned by the executive officer. So just a note on that, be careful of home equity lines of credit to executive officers. Often those, they can be a first lien, but oftentimes they're second lien position. And so you can get in trouble there. We've seen that before where the bank maybe thinks, oh, this is the residence, we're okay, we don't have to abide by the 100,000 rule, but then it's a second lien on the house, not a first lien. And so that, whatever that limit is, if it's 100,000, 200, whatever it is, it counts towards that $100,000 limit. So very important little nuance there. Couple of notes here too. When it talks about refinance, it says, the note says refinance amount only includes amount to pay off the existing obligation plus closing costs. So, they can't do a refinance and get extra money and that not count towards the 100,000 limit. It would count. And the term residence, it doesn't say principal residence or primary residence in the regulation. So it could it could be secondary residence, and that's how we see the banks interpreting that, is that secondary residence counts as well. And the other exception is secured by certain government securities. So loans to an executive officer secured by certain government securities would not count towards the 100,000 limit. The other restrictions with regard to executive officers are there has to be prompt reporting to the board. It just says prompt. What that means, is up to you, up to the examiner, I guess, is looking at it. But I would think, at the next board meeting would probably make sense. Also it has to be preceded by submission of a detailed current financial statement of the executive officer. So again, some vague terms there, detailed and current. I would think current would be within a year, but I would probably want to get something more current just to make sure. Detailed, again, a little bit vague there, so use judgment on that, but probably want to have enough detail to make sense. And then it also has to include a demand clause allowing the bank to call the loan if the executive officer has loans with other banks that exceed that 100,000 limit or 2.5% rule. And that's a fairly common finding that demand clause is not in the loan documentation as well. All right. There's also some record keeping requirements. In general, each member bank shall maintain records necessary for compliance with the requirements of this part. Pretty basic there. Record keeping for insiders of the member bank. It says any record keeping method adopted by a member bank shall identify through an annual survey all insiders of the bank itself and maintain records of all extensions of credit to insiders of the bank itself, including the amount and terms of each such extension of credit. Excuse me. So typically there's going to be, it has to be an annual survey done where the insiders complete this, and they list their related interests and that sort of thing on there. All right. And okay, so record keeping for insiders of a member bank's affiliates. It could be the survey method again, or it could be the borrower inquiry method. I'm going to kind of skim through this a little bit just to make sure we don't run out of time. But again, it can also be an alternative record keeping method, but that would have to be approved by the federal banking agency. All right, and then non-commercial lenders, not sure that's applicable here. Let's get through that. Public disclosure. So this section talks about if you receive a written request from the public. So you could receive a written request from the public regarding your insider loans. So if so, you may have to provide some information to them, and you would want to go to the regulation here and read to understand exactly what you have to provide to them. And you also have to, if this happens, and honestly, I don't know that in the time that I've audited Regulation O over the past few years, I don't recall a single instance where the public has made a written request for information on insider loans. Not that it can't happen, but it's fairly low risk because it's probably not going to happen. But if it did, you have to retain records on that request and the disposition for 2 years from the date of the request. Reporting requirement for credit secured by certain bank stock. So if the bank stock is not publicly traded and an executive officer or a director uses the stock as collateral on a loan, then they have to basically report this to the board annually. Best way to do that probably would be during the annual survey, just to kind of do it all at once. And civil penalties. Yeah, you can get in trouble. So there are FREA civil money penalties that can be fairly high, be very high. They can be imposed not only on the bank, but also on the insiders themselves and employees of the bank. So for example, a tier 3 violation, which is like the highest level violation, that can result in penalties of over $1 million per day. So pretty stiff penalties. And those are typically going to be, like it says on the slide here, typically going to be willful violations where you knew what you were doing, you knew it was wrong, and you did it anyway. All right, so there's some common pitfalls. So we'll get into that. And we've talked about a few of those as we've been just going through the overview of Regulation O. But one of the pitfalls, I'd say number one is just lack of understanding and maybe lack of training on Rego. So I posed a couple questions here. Is training required by Regulation O? And I would say no. I've looked through, I've read Regulation O many times, read through it. I haven't found anywhere where it says you have to have training on it. Some regulations do have it built into the regulation, or it says you have to have periodic training. BSA, for example, you have to have periodic training. However, you know, the other question here is periodic Regulation O training prudent and expected by regulators? I would say yes. In fact, they would expect you to have training on any regulation that is applicable to your job, to your job function in the bank. It's just a matter of how often and how in depth that training should be. And so I've got a note here. It says, unless a regulation or official guidance requires training at specific intervals, your risk assessments, as well as results of monitoring, as well as results from audit and exams, should determine the amount and the frequency of training. And that training should always be role specific or specific to your job function. Some, like, you know, for example, some banks, they don't do very much in terms of Rego lending, very little. You know, I think our polling question, there were, you know, I can't remember the percent, maybe 12% said they had very little Rego lending. Others, you know, kind of push the envelope. So those banks who are doing more Rego lending, they're going to want to have more training on it. You know, make sure it's done annually. You know, if it's something that there's a lot of Rego lending, or if there are a lot of issues, you know, with Rego in terms of the monitoring, exam or audit results, that sort of thing. But you can create a risk assessment to help you determine that. And your risk factors would be things like I said, the volume and number, or the volume and dollar amount of Rego loans you do, the number and maybe the level of findings that you may have had in Rego audits or exams. Those are going to be kind of the risk factors that help you determine how much training. All right, talked a little too long on that one. Okay, so polling question, how often does your bank require Regulation O training? This is anonymous. I don't think anybody's going to see this, so go ahead and be honest. So A would be never, B periodically but not every year, and C would be at least annually. All right, so results, they're kind of split there. There's some that have never on here. Okay, about 19% say never, 39% say periodically, but not every year. 45% say at least annually. So, all right, interesting. Okay, so for those that say never, I would reconsider that. All right, and now you can't say you've never had Rego training because you're having it right now. Okay, so the next slide here. So not understanding the definitions built into Rego is another pitfall. Of course, we've talked about that. Some of these definitions are pretty detailed and there's a lot of exceptions. Recommendation on that would just be training, you know, more training for that. Not designating specific personnel to handle insider loans and overdrafts. Now, it's not required. The regulation doesn't say you have to have just certain people who perform these Rego loans or who handle the Rego overdrafts, but you know, I would recommend that you do at least. Doesn't have to be one person, but I would sort of limit the number of people who can do the Rego loans, because you want to make sure that there's consistency in the decision making You want to make sure that that person has a very good understanding of Regulation O. So this can, having one person or fewer, just a few people, handful of people that handle Reg O loans and overdrafts, that's going to create consistency for you, and reduce the risk of preferential treatment as well. If you could go to if you're an insider and you can go to any loan officer and get a loan, I mean, you're obviously going to go to the loan officer that's your buddy. I mean, that's your, the best. So that's part of it there. Not that you would, I'm just saying. And then potential recommendation, just designate someone competent and trustworthy who will maintain confidentiality to handle Reg O loans and overdrafts, and then provide them regular, thorough Reg O training. And all right, so number 4, improper reporting on the call report. We see that pretty often. I think I touched on that a little bit earlier. So we very often see the overdraft protection lines included in the Schedule RCM calculation. The credit cards, if there's a credit card balance, or I'm sorry, credit card limit of 15,000 or less, you would want to exclude that. And what we see most banks do, I mean, let's say you've got someone has a credit card with your bank, it's got 15,000. So that it has to be. I don't know, honestly. I'm inclined to think that interpretation is accurate, and we do go with that. So also reporting director PPP loans, we've seen some of that as well, where those get reported. They're not considered an extension of credit. They added that at some point, that the PPP loans for directors are not considered a PPP loan, or not considered an extension of credit. And only reporting the outstanding balance of credit lines rather than the limits. I think we talked about that earlier as well. So recommendation would just be to review Schedule RCM, a review of Schedule RCM by someone who understands all the nuances of Reg O, such as your compliance personnel. Let's see, another one here, not having a board resolution in place to specify the executive officers with major policymaking functions or duties, or not updating the resolution as changes are made. And I think, based on that polling question earlier, there's at least a bank or two out there. I think it's just 8%, I think, said you don't think you have a resolution. And just, recommendation would just be to create a template board resolution that you can just, complete every year and kind of fill in those names of the people, have some boilerplate language on there. You just have that completed annually. All right, so not properly documenting board members abstaining from discussion and vote on loans to themselves or related interests. Again, that's one we talked about earlier. So just make sure that gets into the board minutes. We have seen that before, where it's not documented. And again, a proper review of the board minutes prior to approving them, just to ensure that that's documented, will be a recommendation on that. Payment of overdrafts, another issue. Two things to consider on that, really. One is that overdrafts are extensions of credit according to the regulation. So the preferential treatment rules apply, okay? And that would be, in regard to the decision of whether or not to pay the overdraft. And this would apply not just to the directors and executive officers, but to this part of it would apply to related interests as well. And because it is, like I said, it's an extension of credit. So, if you would, you wouldn't want to pay an overdraft of, let's say, a related interest, if you wouldn't pay that same overdraft on a non-insider, in a similar situation. So you want to take that into consideration. The decision to charge a fee, same thing. Let's say it's a related interest, and a business that perhaps a director is a controlling person in a business. related interest, and they're going to overdraw their account. That decision to pay the overdraft, also the decision of as far as whether there's a fee charged or not, there doesn't need to be any preferential treatment. So that's important there. And the other component, and the recommendation again would be to designate a specific person to decision those insider and possibly even employee overdrafts as well. It could be the same person you designate as a Reg O lender. It depends on the size of your bank, of course. It's good to have a specific person who's making those decisions as to whether or not to pay those overdrafts for insiders. And the other component here, director and executive officer overdraft rules. That's another area where we see some issues. Banks paying overdrafts for executive officers and directors. They pay them into the negative, and it maybe doesn't fall into that inadvertent overdraft category. Maybe it exceeds $1,000, or maybe it exceeds the 5-day limit, or maybe there's not a fee charged, like there should have been. So we do see that issue. A recommendation on that, and we see a lot of banks do this, where they will set up a $5,000, doesn't have to be $5,000, could be less, but they'll set up a $5,000 or less overdraft protection for all of the directors and executive officers. And that sort of catches a lot of these to where there's not overdrafts. Now, the good thing about this is that 5,000 or less overdraft protection, it's not considered an extension of credit. And for that reason, you could do, a blanket approval of those. You don't have to go through those same, underwriting standards as you would a non-insider, because it's not considered an extension of credit. So you can do like a blanket approval, let's say to set those lines of credit up for directors and executive officers. Now, I would say you probably want to get their permission. I don't think you would or could set up an overdraft protection line that's interest bearing and has repayment terms and all that without them agreeing to it. Pretty sure there has to be a contract, a note signed on that. So you would want to get their permission, but you could approve the ability for them to have that on credit as a blanket approval. All right. Number 8, related interest surveys. Not obtaining related interest surveys from all insiders annually. That's another potential issue there, one that we see. So I would just recommend, being consistent on that. Provide the surveys to the insiders to be completed, at the same time every year, and require it to be submitted back, to you by a specific date, just like January 31st as example. Also, not obtaining information on loans obtained by insiders using bank stock as collateral. That's another issue that comes up. Recommendation on that is just ask for that information on the annual related interest surveys. Not obtaining current financial statements from executive officers, or not obtaining them prior to the loan being originated. I think on that one, we just, again, require, you should probably require that an updated current financial statement be provided with the annual related interest surveys. Number 11, improper coding of insiders and the related interest in the bank system and software, which results in poor Reg O record keeping and or ability to print accurate Reg O reports. So recommendation there would be, have the person who reviews the accuracy of those data inputs look for proper Reg O coding. Maybe there's a checklist they use to make sure that, hey, all this was input correctly, put on there, that they check to make sure that the Reg O indicator or whatever was checked off in the data entry. All right, and then number 12, there's a concept called dominant management officials. That's those with dominant personalities and or ownership interests that are sort of steering and driving all the decisions. So, you can have a director, for example, that, just is a dominant personality, strong, charismatic personality, and is, maybe they have ownership interest and they're able to sort of steer and drive decisions. This is covered in depth in the FDIC Risk Management Manual Examination Policy Section 4.1. So you might, want to read over that. And this comes up, I think we've seen it a time or two. And recommendation would be set up procedures and processes to ensure that every board member is heard, that everyone's input, including any dissenting votes, is properly documented in the minutes. Number 13, renewals, extensions of insider loans and lines of credit without the same requirements imposed on non-insiders. For example, no credit write-ups, calculations, updated financials, income documentation, etc. And recommendation on that would be to have compliance personnel involved with Rego renewals and extensions, including a review of Rego credit files for evidence of preferential treatment prior to the renewal or extension being performed. So like I said before, a lot of times this happens where, there'll be we've seen this multiple times where lines of credit, these ones that have to renew every 12 months, they just get renewed and there's nothing to back it up in terms of underwriting. So you definitely want to make sure that is taken care of. All right. Number 14, okay, not properly documenting lending exceptions made for insiders in a way that demonstrates no preferential treatment was given. So you should be able to tie back any exception you make. You should be able to tie that back to your exceptions policies. So you should have a policy, and this goes back to fair lending, as well, which we're not talking about today. But you should have a, in your policies, it should discuss, these are the underwriting guidelines, but then, perhaps we want to go outside of these guidelines in certain instances, which would be considered an exception, right? You need to document, you need to have a policy or built into your other policies, something regarding exceptions, why you would make this certain type of exception, a DTI exception, a loan to value exception, et cetera. And it needs to be somewhat detailed. I know some banks, I've heard, that you don't want to back yourself into a corner kind of thing, but it should have some detail to it, and you will, if you don't have some detail there, if it's vague, you will get, the examiners will, point that out. But again, that's talking about fair lending, but also with Reg O, you're going to want to be able, if you make an exception, you're going to want to be able to tie that back to the policy regarding exceptions and say, okay, we made this exception, but we could, because the policy allows it. The exceptions policy allows us to make this exception for this specific reason. And you're going to want to have documentation. Go credit files for evidence of preferential treatment, such as lack of proper documentation to support exceptions prior to the loan closing. Number 15, taking an insider's word for income, assets, et cetera, when the bank would normally require documentation. That goes back to underwriting as well. You're not going to want to take someone not just because they're an insider. And well, didn't mean to advance that one. Okay, recommendation again, not going to read that off, but compliance personnel involvement would be important. And you'll notice I've made that comment on a lot of these, involve your compliance personnel. I think you should. With Rego loans, there's not that, you probably don't do that many. So it would be very easy to, anytime you do a loan for an insider, it would be easy to just involve your compliance personnel and say, hey, can you take a look at this, before this loan closes, or, make sure we're not missing something here. It would be very easy to do that. All right, and number 16, issues with narratives and credit write-ups. Example, stating that the borrower is a board member or a bank employee if they're not only an employee, but an executive officer, as a strength or reason for performing the loan. I've seen that before, and be very careful with any kind of narrative in a credit file. And I'm talking about from a Rego perspective, but fair lending as well. When you start typing words, sentences, when it gets outside of the numbers and you start typing a paragraph, that's when you can kind of get into trouble. The examiners will read that and say, oh, and everybody interprets things differently. So those words you type, they can get you in trouble. So it's might be good to have compliance personnel again involved in that. Maybe let them read over the narratives. Not setting up annual reviews for insider lines of credit to comply with the 14-month prior approval rule is another potential issue. And again, involve compliance personnel, making sure they review those and ensure that any lines of credit, if compliance personnel reviews the line of credit when it's set up initially for the insider, that's something they would want to look for. Okay, this is a line of credit. Is this thing going to renew in a year? Is it going to need to be looked at and approved again in a year? Or is this 2, 3, 4, or 5 years down the road? So again, that's something that, compliance personnel should be able to pick up on as well.